Welcome to Money with Ben. My name is Ben, and this is the channel in where we discuss everything in regards to finance, accounting, taxes, and anything else that's related to money. This is to help educate people who are wanting to get better with their finances and help improve their financial situation. So if you're a business owner, if you're wanting to become an accountant or a CPA like myself one day, or you're just an individual who has trouble with their finances and their personal lives, this series is here to help you understand the fundamentals of accounting and finances and taxes and understanding money. Because if you can understand money, it's going to lead to a lot more success in your life. So, what is the very first thing that you need to understand if you're going to improve on this whole concept of money? You have to understand, and this is something that they teach in the very first semester if you ever go to college to become an accountant. You have to understand the A equals L plus E formula. Assets equals liabilities plus equity. Now, for those of you who are new to accounting, those might just be some random words you probably heard before. I will explain. But here's what I need to get through first. The primary issue when it comes to businesses, when it comes to people, is that businesses and the people who are managing those businesses and the people that are managing the finances in their own lives, they don't understand what money is. And in fact, when it comes to businesses, 9 out of 10 businesses after 10 years, they're going to close down. So after 10 years, only 1 in 10 businesses are going to be able to see their 10th birthday. When it comes to marriages, one of the biggest reasons for separation in marriages is because of financial trouble. Either there's some type of financial dishonesty, some financial mismanagement on one of the spouses or even both of the spouses. The big issue is that they don't know what's in the bank. Or they know what's in the bank, but they don't know what else is going on in their lives. And so it's important to understand what accounting is, to have that fundamental. I know it's boring. I'm telling you, as an accountant, it's a very boring subject, but most of all foundational things are. If you look at a foundation for a house, it's just concrete, nothing too special about it. It's pretty boring, but it's essential for our lives. So let's break down that A equals L plus E, that assets equals liabilities plus equity. Here's the first thing that you need to understand. Running a business is more than just what's in your bank account. It's a very important part of your business. In fact, that's one of the reasons why we get into the business in the first place. We want what's in our bank account to go up. We all want more money. That's kind of the reason why we go into business. Yes, we could have the mission, and that's an important thing, but say you did it for the mission. It's not your business or your mission that you have for your business is not going to do very well until you have something in your bank account. So that is very fundamental. But there are more items that you need to be aware of. So let's break it down. First off, the A, the assets. What is an asset? What does it mean? Assets are everything that you have. So for a business, what does a business have in your personal life? What do you personally have? I'm going to give you a little list of things that you might have in your business or you might have in your personal life, and these are assets. The first one we discussed, cash, of course. Second, short-term investments such as stocks. If you're in your personal life, you might have stocks or a mutual fund or some type of portfolio in some instance. You have that portfolio. That portfolio, those stocks that you have, that's an asset. For a business, this one is more business related, it's called accounts receivable. That's just a big fancy way of saying, hey, someone owes me money and they need to pay me. That's what accounts receivable is. That's an asset because you have someone out there in the world who owes you money. And it's a hope that one day they're going to pay you. And that's why it's an asset, because it has value to us. It's what we have. We have someone who owes us money. Inventory. So say you buy something that you're planning on reselling. Inventory is an asset because you have supplies that you're going to be reselling. Say, for example, in many cases with the manufacturing industry, they buy raw materials so that way they can convert it into a product. Those raw materials are inventory. They have those raw materials. And at the very end product, that's inventory too. So whenever you see all those things like in a Walgreens or a Walmart, all those things that you see on the shelves, that's inventory to the business. That's what they have. They have those groceries. They have those kitchen appliances. They have those pharmaceuticals, whatever it might be. These first four, they're going to be very common in a business or in your personal life. Cash, short-term investments, accounts receivable, and inventory. Those are a lot smaller, and they tend to have their own category, which we call current assets. It's basically assets that you plan on using in less than a year. So when you have cash, you plan on spending that cash pretty quickly. You're not going to keep it in your bank account for more than a year. Imagine that. Imagine having cash and not being able to spend it for more than a year. Or having stock that you have to just keep in there and you can't sell for more than a year. We call those current assets because they have the ability to liquidate or the ability to turn into cash, like we can sell them for cash in about less than a year. So we call those current assets because we currently use them. But then there's another group we call non-current assets or long-term assets. So these are the things that you have that might last a little bit more than a year, sometimes a lot more than a year. What are the big ones? Buildings. You know, you can have a building. There's a lot of businesses that they own buildings, like a hospital. They own that hospital building. It's a pretty big building. Chances are they may not be able to sell it or use it up in a year. So that's why it's a long-term or non-current assets. But they have that building. Equipment. So say you have this big fancy machine they use to manufacture their product. That is an asset because you have that equipment. I hope this is becoming a little bit straightforward. Oh, land as well. So you need land to put the building on top of it. So you need to have that land as well. So these are all assets. These are all what you have. And I challenge you, just go into your regular life. Do you have any of these assets? Do you have cash in your bank account? Do you have stocks or some type of portfolio or 401k or mutual fund? Do you have people who owe you money? Do you have stuff in your business that you are needing to sell? Do you own a building, like a house? A lot of people in their personal life, they own a house. Do you have some special machine to help provide a service or to sell something? Guess what? You have assets. So you are part of this accounting equation. You are part of this accounting knowledge. So whether you like it or not, you're part of the accounting world. I hate to break it to you. So that's A, that's assets. So what is the L? Liabilities. Liabilities is simply everything that you owe. Do you owe money? Something that you have to pay back in the future. So this one, it can be a little bit easier to grasp because we all know what we owe. Like for example, bills. Bills that we need to pay. Those are liabilities. We owe those companies a certain amount of money and the bill is just reflecting how much we owe. Another fancy word for this in the business world is called accounts payable. It simply means that we have an account with a company that we need to pay. We could say bills, but sometimes we accountants, we like to sound fancier than we actually are. There's also some short-term debt. Sometimes you might have a loan with someone and they say, pay us back in a year or less than a year. We call that short-term debt. So debt is money you owe, but it's paid in a year, so we categorize it in short-term debt. So this is what we call our current liabilities. Just like current assets that they are used in less than a year, current liabilities are paid in less than a year. But just like how there's non-current assets or long-term assets, there's also long-term liabilities or long-term debt. The biggest one, the most popular one that we all kind of know, especially if you own a house, is a mortgage. A mortgage, you have to pay that off over a span of 15 to 30 years, sometimes 40 years, depending on your mortgage terms. That's a long-term asset and you owe it. You have to pay it back eventually. It's not something that you have in particular, and it's not something that you honestly want to have. In fact, when it comes to liabilities, they are necessary in certain occasions, but the goal is to have your liabilities to be as small as possible because no one likes to owe. No one likes to owe stuff. But unfortunately, in order to have stuff, sometimes you have to owe stuff. It's just one of the unfortunate realities when it comes to accounting and when it comes to running a business or running your personal life. Credit cards, that's another reason. That would be more for current liabilities. because credit card balances, hopefully you're paying them off in less than a year, but in many situations we find ourselves holding on to that for a long term. But for accounting reasons, we use that as current. So that's L, liabilities. Now we get to the last one, and this one I would say is the most important one. E, which is equity. Equity is simply what you own. And there's a difference between what you have and what you own. Because you can have a house, but how much of that house do you actually own? Because you gotta remember, for the most cases, that house is tied to a mortgage, right? If you have a house that's worth $100,000, but you have a mortgage on it that's $90,000, let's do a little bit of math. 100,000 minus 90,000, what's that? 10,000. So how much of that house actually belongs to you? $10,000. You only own $10,000 of a house. It's a very small portion. And the goal of accounting is to make sure that you own as much as you can. Because there's no point in having all this stuff. There's no point in having cash, having all those nice stocks, having people owe you money, having all this inventory that you're ready to sell, having a giant building, and having all this fancy equipment. None of that matters if it doesn't belong to you. If it belongs to someone else, then you kind of miss the whole point of running the business. So we want our equity, what we own, to be as big as possible. But there's some terminology that's important to understand when it comes to equity and what we own. There are two ways that you can increase what you own. One is through investing into the business yourself. Let's say, for example, I put $10,000 into my brand new accounting business. I'm an accountant. I have my accounting business. So let's just say I put $10,000 into my brand new accounting business. Here's the good news. $10,000, that's what I have, but I own those $10,000 because I personally invested it myself. So personal investments to a business, that's equity, pure equity. Brilliant. Perfect. But there's a piece of equity that's a lot more important than just your own personal investments, and this is called earnings. This is where we also get the word profit, or another word, net income. Just all different fancy ways. You'll find out that accountants, we love to mix up terminology, but here I am trying to keep it as simple as possible. So we have earnings. The whole point of the business is to earn money. And not just earn money, but to earn money that belongs to us. So the good news is when you sell that inventory and you get that cash, guess what? That cash, it belongs to you. You own it. Earnings are yours. You own those earnings. And we, as accountants, we divide the earnings. We have current earnings, so the earnings that you made this year. And then you also have retained earnings. So it's the earnings that you had in the previous years that you decided, you know what, I'm just gonna keep what I own in the business and I might take it out later because, you know, that belongs to you. You can take it out at any time. So we have investments, we have current earnings, and retained earnings, which is just previous earnings that you just held on to. So all this comes together to create the A equals L plus E. Assets equals liability plus equity. Understanding this, understanding that there are different aspects to this is going to broaden your horizon. So now you're thinking of more than just cash in the bank accounts. You're thinking more about looking at your bank statement or looking at your phone saying what your balance is and say, money's there. Because that can be deceiving as well. You might have $10,000 in your bank. You might have $10,000 in your bank. You might feel good. But what if you have $20,000 in bills? $20,000 in credit cards? How much of that $10,000 really belongs to you? The answer is zero. None of that money belongs to you. It belongs to those companies. It belongs to that credit card company. It belongs to that vendor that you still owe money to. It belongs to that mortgage broker. So we want to make sure that we understand the full picture of accounting. And if it doesn't make sense right now, don't worry. As time goes on and as we continue with these lessons and everything that I learned in regards to accounting that I'm going to be sharing with you, you'll see how these different accounts, we call these accounts just the different categories, how they all come into play in order to run a business. But if you want to get better at your finances, you want to be able to calculate taxes better, you want to be that CPA in the future, get that fancy title, or you just want to run your business better or just run your personal life better, you have to understand the A equals L plus E. I'm going to stop there. There's a lot more that I really want to show you, so stick around for the next videos that are to come, so that way you can improve your financial well-being. But until then, this is Money with Ben. My name's Ben, and I will see you next time.